Boyke, you just asked the question, which is second, you said after. Diversification. Diversification. I find that there's really two common denominators: simplicity, including risk control, so keeping things consistent and simple, and diversification. So I bring that up, by the way, for a reason. When we're using Fibonacci analysis, one of the reasons why I like it is because it's a very technical. Um, I mean, it's one of the core fundamental analysis techniques. So it's one of those things that, or I'm sorry, core technical analysis techniques. So it's one of those things that that technicians will use, and it more or less ignores fundamentals. Now, I'm not advocating that you ignore fundamentals, but what that does is it really gives you kind of an impartial view of from pair to pair to pair, or from asset class to asset class. So, which enables, I find it very helpful in when I'm trying to diversify my holdings, because I can use a technique like this to look for opportunities in crosses and things like that. So if I see that the dollar is going crazy, or just something is really out of control with a particular currency, or the yen or what have you, I can get into some of the crosses and neutralize some of that impact, but using virtually the same kind of analysis that I might use otherwise. All right, why don't we get started? I'm going to actually spend almost all of my time on the charts, so I'm just flipping through my charts right now. Hang tight for just a minute. And what I want to do is start out by chatting just a couple of the basics behind Fibonacci analysis. And as I start looking at the Aussie dollar here, I've got a couple of examples of how this worked, and how can you design a trade, a couple of really easy ideas behind designing an entry point and a stop loss level, etc. But I've got a question here that says, do you use fibs on all your derivatives? I.e., do you find them more favorable with certain products? So is it is it easier to use with different asset classes? So is it easier to use with bond futures or with currencies or what have you? I suspect that that's your question. So, and it's a good one, actually. No, I don't see that there's a lot of difference, actually. I find it pretty useful regardless of the asset class. But here's a comment that I would make. One of the things that I do quite a bit is intermarket analysis. So, for example, when you're using Fibonacci analysis, sometimes the signal is quite ambiguous, and it's hard to say, well, we may pass on something that looks a little hinky. You can't really tell, is this really a bounce, is it not, or is this just kind of random market movement? But comparing it to what's going on elsewhere in the market, so for example, applying Fibonacci analysis in the same way to the gold market, while I'm looking at the Aussie dollar, sometimes you get a much clearer signal there that you can use to trade the Aussie. So I would say that's not really the question you were asking, but I think I've answered both that, as well as just saying, I think it's very helpful when using intermarket analysis. The TNX and the franc is another good example of an intermarket relationship that you can use Fibonacci analysis on both asset classes. Okay, so the first technique that I wanted to talk about is a Fibonacci retracement. So what this basically is, and what I've done here in this case with the Aussie US dollar, is I've identified the top and the bottom of a previous trend. So now, one of the questions that I get quite a bit about Fibonacci analysis is, how do you know whether this is the actual bottom, or do you want to back up even more and go back to a previous bottom? What would you do? Well, more often than not, actually, the reason why Fibonacci analysis is so helpful is because the market tends to move in these consistent wave forms. So these ratios occur over and over again. And specifically, I'm talking about 23, 38, 50, 61.8%. Oftentimes, you'll talk to two analysts who are both using Fibonacci retracements, but they may have their points drawn at different levels. It really doesn't make a whole lot of difference. So it's one of those things that we look at as So often, what basically that boils down to is that there are good signals regardless of where you're placing your points. I find that the most important factor is just to identify very significant levels of tops and bottoms. So in this case, obviously the decline in August, most of us probably remember that. It was a major disruption in the market. And then the top in October, November was a big deal, even resulting in a gap there on November 12th. So that's why I picked those two levels, because they were significant and it was far enough back in time that I wasn't crowding my analysis. Let me show you exactly what I mean by that. Oftentimes I'll talk to new traders, for example, who are using Fibonacci analysis, and one of the traps that they fall into is doing this sort of thing. Well, where they will identify a major bottom and a major top, but what it does is it scrunches their retracement lines really tight right here. If you want to do this kind of analysis, if you want to do a Fibonacci analysis, but what you find, but you find that your Fibonacci levels are each, I would say that 50 pips, which these are about 50 pips apart. That's probably too tight in just about any pair, and it's going to lead to a lot of false signals. So a lot of whipsaws, in fact, and it's much more difficult to manage risk when you've got if you're looking at the daily bars, but you have Fibonacci levels that are closer together than even just your average daily range. So food for thought as far as placing your Fibonacci analysis is, don't get too hung up on making sure that you're picking the absolute top and the bottom, because it's somewhat subjective. It's a matter of picking significant tops and bottoms. If you want to analyze this particular portion of the trend, I would break the chart up into like an hourly chart or something like that, maybe 4-hour chart, so that you get a wider distance and you're able to get a much better view as to how do I want to manage my risk here. So question that I had is, do you ever add the 14.6 or 78.6? Sometimes a sizable move will reach the 78.6% retracement level, which would be down here. That's a great question. So personally, I don't. I like to keep it fairly simple, and I found in my own personal experience, I've found these 4 levels to be the most reliable. You can continue to kind of divide the Fibonacci retracement levels into finer and finer segments. However, I think it's more personal preference than otherwise. But you've got a great point, and I don't think that I would object to. I don't think that I would suggest to somebody that they not use a 78.6 or 14.6. The reason why I don't, by the way, is that I don't like to crowd my chart. I don't like to have to account for too many different levels. And if you're looking across the market, there's generally so many other opportunities that it doesn't really require me to go in and tweak it too much. So how do you predict which level the price will retrace? So this is a great question, by the way. And why don't we use this as our case study? This is the Aussie dollar. This was, by the way, an analysis that I did do. So I'll answer your question, and then I'll talk about how would I set up a trade here. Now, this is my suggestion. It's not necessarily a recommendation, obviously, and there are a couple of wild cards, relative. I mean, that's true with any trading strategy. So I want to kind of put that caveat in there. So how do you predict which price level or which Fibonacci level the price will retrace to? I don't. The way that I take a look at it is that the price level that the market has bounced off of is self-evident after the bounce. So let's use an example here. We would have applied this analysis after the break in November. So by the middle of November, we had this analysis in place, and we're looking for a bounce. Well, as you can see, the market broke down, hit the 50% level, or virtually so. And at this point, all we're alerted to is the fact that there may be an opportunity. Now, here's what I do. As prices approach one of these levels, whether they're touching it or just barely crossing through it like they did here in January, I wouldn't invalidate these points. And as we get closer we get to that, I start to plan my trade. And the way that I do that is I pick basically the midpoint between 2 Fibonacci levels, and I put a long limit order in. Now, I'm already biased to the long side because my previous trend, or the trend that I'm analyzing, was to the upside, and now we're getting a correction. So as the market approaches the bottom side of this Fibonacci level, I haven't predicted that it would, but as it pops up above it, it catches my limit order. So at this point, I've identified the bounce, not really predicted it. I hope that makes sense as a difference, identification versus prediction. Now, at this point, of course, we're challenged with a couple of decisions. Number one, we have to address, well, where do we think that the market is going to go? And I actually have a longer discussion about that I'm going to get to here in just a minute. How we can use fibs to or Fibonacci retracements to project where we think prices are going to go, because that's always a big question. Certainly is in my mind. But the other one that we have is, well, okay, so how do we manage risk at this point? What are we doing to manage risk? Because we need to know those two questions. We need to know the answers to those two questions so we know how to size our position. Well, I approach this in two ways. So number one is I have a very general rule of thumb that I'll look for placing my stop about a third of the way below the next Fibonacci levels, which in this case was 50%, and the 61.8%, so about 30% of the way below that level, which let's just say it's putting me right about there. So that's I'm kind of approximating this, but I think it would have come in about there, about a third of the way. So the idea here, though, is, of course, I've got a limit order in that's getting me in at about 86.44, and I have a stop loss down here that's at about 84.75. So at this point, where do I think that the market is going to go? And I always set an initial target of the next Fibonacci level, which is 23.6 in this case, which was 90 even. Now, at that point, we start to reevaluate what we want to do with our stop, and usually I'll move my stop up to, if not the 50% level, all the way up to break even, because the market has moved enough. Couple of general rules of thumb. Now, why would you perhaps modify that analysis? Maybe open your stop loss up a little bit more, or leave it untouched, or even tighten it up a little bit more. You kind of have to look at market conditions. So that's one of the things you always have to account for. Like, for example, recently the average trading range on the Aussie dollar has been very wide. So if we really want to trade the Aussie dollar with a Fibonacci retracement, you're going to have to give yourself, on the daily charts, you'd have to give yourself a lot of room, because just the average trading range is going to be big. So here's what happens. Here's my experience with Fibonacci analysis, is that as you make this, in this case, we hit the initial profit target up here, the 23.6% retracement level, which was at about 90. Subsequently, the market turned around very fast and began to decline, and eventually I exited the position at about break even, because we'd moved our stop already by that time. So it was a small loss, but not terrible. What I have found with just about any trading strategy that's based on technical analysis is you get a lot of small losses, and every once in a while you get the big win. So which offsets those small losses. That's been my experience as a trader in the market over the last several years. As you can see, the exact same setup happened in January, where the market again hit the 50% level. We would have done virtually the same analysis. We would have had our limit order placed right there and a stop placed underneath the market. Okay, great question. I just paused while I read this question. So the pair retraced to the 50% level, and then came back, retested that level, and popped up, and that was the trade that was the big winner. Obviously everybody's been long the commodity currencies over the last couple of months, has done really well despite the recent volatility here today. We're still doing well. Is it safer to wait for that confirmation or that test? So here's my opinion, Len. I typically don't. Now, however, I would, if it's hit this level, if it's hit the 50% level and bounced off, I don't mind taking the position. And I have not seen that waiting for the retest actually improves my trading results. I find that the probability is the same. However, it's certainly something that you may want to test in your trading and see if it does improve your analysis or if it doesn't. But I haven't found. I guess the bottom line is, it seems to me that these trading opportunities are independent of each other. They don't actually have, they're mutually exclusive. They don't actually affect the probability of having a successful position. Now, yeah, great question. If it hits your stop before your limit, won't you be short? So what I do is I have contingent orders that the stop won't be placed unless the limit was actually placed. So you can talk to your dealer if you don't know how to do this, because they can show you, and generally most good dealers have conditional order types, which means that you can basically set an order that says, if my limit gets hit, then I want a stop loss placed down here. Otherwise, no stop loss placed. So so that you don't get short when you didn't really intend to. Okay, so let's continue on here, because I want to show a couple of other examples. One of the comments that we get, one of the things that we think about all the time is, well, once the market is breaking out and we're kind of we're targeting these each sequential Fibonacci level as our next level of a profit target. But is there a way that what about when the market breaks out above that level? Or alternatively, what happens when the market breaks out of something that was independent of our Fibonacci analysis? Is there a way we can use Fibonacci's to create a profit target? And let me show you something that I use that I haven't seen a lot. I have seen some traders doing this, but I think it's actually quite beneficial. So I'm gonna remove this for just a minute. Okay, so this is the dollar yen. We're all, I'm sure, quite familiar with what's going on in the dollar yen. Well, I have found a very useful tool is when the market is consolidating, such as it did in December and January. So we had this very tight consolidation, similar to the consolidation that we had very recently on the not quite as wide a trading range, but the consolidation that we had on the Aussie dollar. When it finally breaks out, we have an opportunity here to take a position. So this is, Fibonacci analysis is not the only thing that we're doing to try to find opportunities. And when the market finally was breaking out, which I think it was safe to say that by the 27th of February, the market was in fact breaking out. Now, where is the market likely to go? Well, assume that we had no Fibonacci analysis on this. We weren't trading a break of Fibonacci analysis. We were trading a break out of this consolidation level, which most of us are probably familiar with, whether it's a pennant, a flag, a triangle, regardless. I'll take a Fibonacci retracement. I'll identify the bottom, the most extreme point of that consolidation level, and the extreme high of that same consolidation level. What that's going to do is it's going to draw Fibonacci retracements. Now, I'm not interested in all this stuff up here. I don't care. You'll notice all of these are real tight. They're too tight to be usable anyway. What the levels that I'm interested in a breakout like this are these, the 161 and the 261.8% retracement level. And specifically, what I'm interested in is, where am I likely to experience some consolidation in the market? Where would I forecast that there's some likely support areas if the breakout is to the downside, or some resistance area if the breakout is to the upside? Well, looking at this analysis, I would initially say, well, clearly the 161.8% is likely to be a transition or an inflection point in the market, which it turned out to be for about a week and a half. And then the 261. Now we had a breakout here, so we're, again, today, so we're reevaluating our analysis. But as of Friday, that was where I was placing support, was 261.8, because of the based on the breakout here on the from January through February. You can see virtually the same thing. Let's change our instrument here a little bit to the Swiss franc, where once the market had broken out of this consolidation, or this channel that it had been in January and February, we could do virtually the same thing by picking the extreme bottom and the extreme top, and we get an idea as to where are we likely to experience some consolidations. So why is this important? The reason why is that I find information helps confidence, right? So it makes us a lot more confident about where do we think the market is, where should we be applying risk control. Here's a very specific example. So once the market broke down on the Aussie franc, so it broke down below resistance here about the same time the yen was. We all, I mean, this is recent enough. We all remember this on 227. So we're looking at near-term support at the 261 and the 161.8% retracement level. Once the market hit this level and began to bounce up and shimmy around, it's not necessarily a trigger to exit, but it is a trigger to start to reevaluate how we're controlling our risk. Meaning, are we moving our stops down to past break even, locking in some of those profits? Alternatively, one of the presentations I've given several times here on FX Street are how can we manage risk with options? Is there an opportunity to buy a long call right here at this position to act as a stop loss without the danger of a whipsaw? So this would be the level to trigger such a position. Okay, so let's back up a little bit. I'm going to scroll out on my charts, and I want to take a look at a couple of things here. I'm getting the question as to, you can only see the U.S. dollar Swiss chart. That's the one I'm looking at, is the dollar franc right now. Okay, so one of the other methods that you can use to kind of make your analysis. You know what? Let's do one more profit target example, and then we'll go on to another Fibonacci tool. That's really it has a very high level of coolness factor, but it's also a nice way to look at where do I think the market is likely to go. How do I forecast where that support level might be? So I had a question as to how do I predict rather than just identify? Well, there are a couple of tools that we can use to at least alert us to the potential in the future. But let me get to that here in just a minute. First of all, I want to take a look at, I've been talking about using Fibonacci levels to project, so I'm going to get rid of this and we'll draw it again, to project price targets. So, for example, looking at a breakout from a consolidation pattern is a really easy way to do that, which we looked at on both the yen and the dollar franc. Right now, I'm looking at the dollar CAD. Now, there are a couple of situations that are like this. I'm sure most of us have been trading, or if not trading, at least watching the breakout below the head and shoulders pattern that's occurring on the pound yen. Well, there's something similar going on here on the it's it's a much smaller scale, but there's something going on like that right now that I've been watching here recently as on the dollar CAD. So you can see this trend line that I've drawn is across the neckline of this head and shoulders pattern. So we got a shoulder here, head here, shoulder here. We got a little breakdown. We got a couple of tests. We're on our third test of the neckline. So already the market is I'll tell you, I have to make a little side note here. If you don't know already, if you're a new trader and you haven't been in the market in 98 and 2001, and even before that, this is one of those times that people are going to stop talking about 2001 and 98, and they're going to start talking about late 2007 and early 2008, because this is major stuff. This is really fun stuff that's going on right now in the market. It's entertaining to say the least. Okay, but that's not my point. My point is, if we're trading this market short, so we looked at this head and shoulders pattern. We saw this breakdown off the neckline here that happened on the 26th. It's coming back. It's retesting the neckline a couple of times. We're not too worried yet. It hasn't broken back up above it. So what I'm more concerned about at this point is, where do I think the market's going to go? Well, there's kind of a traditional way to look at this to create price targets by measuring the distance between the neckline to the top of the head portion of the head and shoulders pattern, and then project that same distance to the downside. Well, that's reasonable. That works, but I have found actually using a Fibonacci analysis is a lot more accurate and it's much less ambiguous. So let me show you what I mean. Essentially what I did was I applied this Fibonacci retracement to the bottom of the neckline here. So the extreme low, essentially, of this head and shoulders pattern. and then drawn it all the way up to the extreme high of this Fibonacci's pattern. Oh, by the way, I want to make a little note here. You'll notice that I attach my Fibonacci levels to the extremes, to the shadows. There's some debate about that. I know a lot of technicians who don't do that. They'll attach the Fibonacci retracement to basically the close price, or the absolute low price between the open and close, or the rather than the shadows or the extremes. I don't think that there's a right or wrong answer to that. My attitude about that is that I like to capture the extremes, because it grabs where, I mean, in my opinion, as far as technical analysis go, the extremes are more useful than just about any other piece of information that you can get. Okay, so back to my point. We've drawn this Fibonacci retracement level, and I'm not interested in this middle stuff because I'm just using this as a target. So, which it's drawn my 161.8% retracement level. This is what I'm targeting. So if the market doesn't fail this particular pattern, and in fact breaks down to the downside, I would assume in the intermediate term, so over the next weeks, to see just below the 9,400 level as a profit target. That's how I would start to plan my trade. And it's the kind of information that I would use to answer the question of, well, how much do I want to risk? Because if my stop loss is way up here above the neckline to account for some volatility, do I have enough room down here in the bottom to justify a big position, a small position? You know, what's my risk reward? So how big is my total size? Does an option position make more sense here based on how far I think that the market is going to move and how quickly? But it gives us a little bit more specificity than we might have otherwise. So I mentioned that I wanted to talk about, is there a way that we could forecast things that may be important in the future? And I think that there is. So let me give you an example here. I'm going to get rid of this neckline pattern. I don't like crowded charts. And I'll leave the Fibonacci analysis here for now. There's another kind of Fibonacci study, by the way. I'm not going to talk about fan lines today because it's a whole nother discussion. But it is something that's worthwhile. If you want a little bit more information about it, I have some tutorials on my site that you can go check out. But there's Fibonacci time studies. These are really simple studies. Now, and the way that they all work basically the same. Once you've selected your Fibonacci time study from your technical analysis charting package, and you apply it to an extreme in the market. So that's what I do. And in this case, the extreme in the market was back here in November on the 7th. Now, what you'll notice is that it subsequently draws several vertical lines. And what these are based on, by the way, are the Fibonacci number series. So 1, 1, 2, 3, 5, on down the list. And it basically identifies, it puts a line at each one of those Fibonacci levels. Well, these first few lines are so tight, they really lose all meaning. So I don't pay too much attention to them. And it's not that big of a deal because you're usually going back in time. Once this significant bottom or top has been established, you're generally going back in time anyway to apply the analysis and start looking at, well, what's likely to be going on in the future. So let me show you a couple of things. Number one, you'll notice that one of these lines occurred right on the absolute top of this head and shoulders pattern, which at the time alerted us to the fact that there was a resistance level there, and there was a very high probability for the market to transition. Well, the same thing, I concluded the same thing based on this next Fibonacci time series number, which occurred at 310, that the market was probably hitting a top and was likely to break down. Now, the great thing about that was that at the time, it was bouncing off of its neckline as well. So, okay, so basically, at the same time that the market was was in decline, that the market hit this Fibonacci time series number, it was also hitting that neckline. So let's redraw that neckline so you see what I'm talking about. Okay, we'll bring it up to the bottom of this point here. So we were getting into this retest where all of a sudden we have this confluence of situations here. We've got this resistance line of the neckline, we have a Fibonacci retracement level, and we have our time series number. One tip, by the way, for those of you who find this interesting, one of the best things I can suggest is start applying time series. They're really interesting, and go back to a significant top or bottom, plot it there, see if it has identified significant tops or bottoms in the market, and start getting a little bit of experience for it. But one of the things that I can suggest as a helpful hint is I have found them to be most useful in a channeling market. So a great example, by the way, would be what's been going on the Kiwi. So this insane channel, upward trending channel that we've been experiencing over the last while. The Canadian dollar was a good example, and one currency I don't know if a lot of you traded or not, but I love it, is the Mexican peso. So here's the dollar peso. And it channels like crazy, and it's in a big range. The spread's really wide, so you have to be aware of that. But I find it very useful, actually, as because of that, how outrageous the channel is. Well, so back here in August, the market hit this really significant and extreme top, which was, by the way, coincided with the top of that channel at the time. And if we apply a Fibonacci time series to that extreme top, so that's all I'm doing right there, you'll notice is pretty predictive. So it identified, once we got past kind of this cluster where things are a little bit too close. I'm sorry, I'm getting a note that let me refresh my chart. Hang on one second. Okay, so you should see the dollar Mexican. Let me. This is a good one. So I want to back up a little bit and really show you this chart. So this is the dollar peso, and like I mentioned before, it's one of the things that I find very useful about the dollar peso is that it channels outrageously. It has big trading ranges. It has a big spread, so that's kind of the takeaway. But particularly if you're a forex futures trader, so a currency futures trader, it's not as bad. Most spot dealers who offer the dollar peso, the spread's a little bit egregious, but it's still not too bad. Okay, so I'm going to zoom in here, and all I'm doing is, back in August, the market hit the top of the channel here on August 16th, and it formed this really extreme high. Well, we would have been able to identify it by the time the market was breaking down here in October. And so when we apply our time series to this number right here, and we ignore where the time series is all clustered up right there, but we start looking forward in the future. So since that time, we've been looking for major transitions in the market that would coincide with these next Fibonacci levels, or time series levels, which occurred here, for example, on the 1st of February, again on the 19th of December. And as you can see, major bottoms or tops were occurring where these time series numbers were. So including one very recently here on the 5th. So now, my point here actually is not necessarily that these trigger a trade in the opposite direction of the trend, but that if they coincide at the same time you're seeing a bounce off of support or the bottom of a channel being reached or a price target being reached, etc., it's definitely an alert that the market has a very high probability of being disrupted at that point, which is both an opportunity for profits as well as a chance to apply some risk control. Okay, I'm going to pause there. We really talked through Fibonacci retracements as well as time studies, some of the ideas around applying them, setting profit targets as well as stop losses and entry levels. Are there any questions? So Boyke, I'm not sure if I understand your question precisely. How do you pick the time series? Maybe you could go into a little bit more detail. While you're thinking about that, let me make one comment here. I have noticed that there are charting packages are not built by traders; they're built by programmers. So even if they say they're built by traders, they're usually not. They're built by programmers. So they get things wrong a lot. It's not uncommon. And I have seen actually a couple of charting packages that have Fibonacci time series studies that are completely erroneous. So that's one thing to keep in mind. The time series, for example, is fixed intervals. There isn't really any change. You only select one point in time. You don't actually pick a trend. You pick the absolute top or bottom or point, because it's just calculated as they're going forward in time equal to the Fibonacci number series. So that's why they're increasing their width is increasing progressively with time. So as you can see, if I'd moved this same study from the major point in August to the most significant correction here that happened at the very beginning of November, we again have identified some very likely levels. So this is just a good illustration of how these things move in waves. So you don't actually, with the Fibonacci time series, you don't actually pick, you only pick one point, and those fixed intervals are applied automatically. So it doesn't actually require you to pick the second point in the market like you would with a retracement or fan lines or what have you. So the question is, do I use fib bands? I don't. However, I don't have anything against them. It's kind of a matter of trying to simplify your analysis. So everybody's kind of got their favorites, but I hear good things. So it may be something that traders should check out once they feel confident that they understand how Fibonacci's work and are using some of the more simple analyses successfully. So do time series work on all time levels? Yeah, I haven't seen that there's a big drawback with using them on longer or shorter time frames. I would say that, and this is personal opinion here, but I think the disadvantage of using Fibonacci analysis on shorter time frames, so 15-minute charts or what have you, is the same disadvantage that exists of using short-term time frames, period. It's tough. The market moves very fast, and especially for new traders, it can be extremely difficult to manage on a day trading basis, whether you have Fibonacci analysis or not. But it's independent of time frame, so it doesn't really. It's not really. I haven't seen it be ineffective, regardless of what time frame you have. I think just as a tip, I wouldn't use it on on tick charts. Now I'm kind of kidding there, but moving it down to 1 minute or less would be. I think it would lose a lot of its emphasis. So what is a time series supposed to predict? It's supposed to predict periods of market volatility. So as you can see here, applying it to an extreme bottom, what it did was, we ignore these first few lines. They're just clustered too tightly together, and we start to look at these major tops and bottoms. And in this case, what we're looking for is for it to predict where the market's going to get volatile on us, which it did here in the beginning of March and again at the middle of January here on the dollar peso. That's what we're using the Fibonacci time series to do, is to predict volatility. Okay, well, I've run out of time, so what I'd love is if you have a question that didn't get answered and you want follow-up, feel free to reach me via email. It's John at pfxglobal.com. You're welcome to email me there, or come see me on the site, which is www.pfxglobal.com. Thanks, everybody. Have a great day trading.